The 2026 market crash is coming, and it will be the single greatest wealth transfer of our lifetime. While everyone else is panicking, this video gives you the complete 3-step blueprint to turn that crisis into a fortune. We'll cover cash preparation, your stock market hit list, and the entrepreneurial ventures that thrive in the chaos. Let's get started. Cash is king. The first and most critical step in this whole process is preparing your cash. I know it sounds wrong. We're constantly told that cash is trash, that inflation is eating away at your savings, and in a normal growing market, that's mostly true. But when a storm is gathering, cash isn't trash. Cash is power. It's security. It's opportunity, just waiting to be deployed. Far more money has been lost by investors trying to time corrections than has been lost in the corrections themselves. Preparation, not prediction, is the key. Your first job is to build a financial foundation so strong that no market downturn can force you to sell. This starts with your emergency fund. We're not talking about investment money here. This is your survival fund. Most advisors suggest holding 6 to 12 months of essential living expenses in an account you can get to easily. This isn't just a buffer, it's a psychological weapon. When the market is down 20% and your friends are panic selling their portfolios to cover a surprise bill, you will feel calm. You'll feel secure. That fund ensures you never, ever have to sell your investments at the worst possible time. It lets you watch the chaos from a position of strength, not fear. Once your emergency fund is locked down, the next step is building your dry powder. This is your war chest. This is the capital you're going to deploy to buy discounted assets when there's blood in the streets. This cash needs to be separate from your emergency fund and your regular long-term investments. Think of it as the ammo for the opportunity of a lifetime. Now, on the personal finance side, getting your cash ready also means cleaning up your own balance sheet. You need to ruthlessly attack and restructure any high-interest debt. Consolidate your credit cards. Refinance your mortgage if you can lock in a better rate. Every dollar you free up from debt payments is another dollar for your war chest or your financial resilience. When the market turns, the people with low overhead and lots of cash are the ones who can move decisively. You want maximum financial flexibility so that when an opportunity shows up, you can act without thinking twice. For business owners, this is even more critical. Now is the time to optimize your cash flow. Get your clients to pay you faster. Negotiate longer payment terms with your own suppliers. Hoard every bit of working capital. During good times, you should be building cash reserves as if a downturn is just around the corner. Get rid of high-interest business debt that could become a crushing weight if your revenue tightens up. Finally, let's talk about where to actually keep this cash. You don't want it all sitting in a checking account earning nothing. You need a liquidity hierarchy, a tiered system that balances easy access with decent returns. Your immediate funds, money you might need in days, can sit in a high-yield savings or money market account. Your short-term reserves, the cash you plan to deploy over the next 3 to 6 months, could go into short-term CDs or treasury bills to earn a little more. Your medium-term reserves can be laddered in instruments that mature over 6 to 12 months. This setup makes sure your cash is working for you, even a little, while staying ready for action the moment the right price appears. Having this cash ready and organized is what separates the people who watch a wealth transfer from the ones who take part in it. Your stock market hit list. With your cash position secure, we get to move on to the exciting part, going on offense. A market correction is just a sale on the world's greatest companies. It's Black Friday for building wealth. But just like you wouldn't run into a store on Black Friday and just grab things at random, you can't go into a market crash without a plan. You need a hit list. The biggest mistake investors make in a downturn is trying to time the absolute bottom. It's a fool's errand. Professionals with supercomputers and floors of analysts can't do it consistently, so neither can you or I. Trying to catch a falling knife is a recipe for disaster, so we're not going to do that. We're going to use a systematic, disciplined, and unemotional strategy called dollar cost averaging, or DCA. DCA is just an investment technique where you invest a fixed amount of money at regular intervals, no matter what the market is doing. This simple move fundamentally changes your relationship with volatility. Instead of fearing price drops, you start to welcome them. Here's how it works. When you invest the same amount of money each month, you automatically buy more shares when the price is low and fewer shares when the price is high. Let's use a quick example. Say you have $5,000 to invest in a great company over 5 months. In month 1, the stock is at $20, so your $1,000 buys 50 shares. In month 2, the price climbs to $21, so you only get 47.6 shares. But in month 3, panic hits, and the price drops to 18. Your $1,000 now buys you 55.5 shares. In month 4, it hovers at $19, getting you 52.6 shares. By month 5, it recovers a bit to $21, and you buy another 47.6 shares. After 5 months, you've invested your $5,000, and you own 253.3 shares. Your average cost per share isn't $20 or $21, it's $19.73. You use the volatility to your advantage, automatically lowering your cost without ever having to guess where the bottom was. That's the power of DCA. It takes emotion and timing risk out of the equation and gives you huge psychological stability when the world feels like it's falling apart. But what do you actually buy? This is where your hit list comes in. A market crash doesn't make a bad company a good investment. It makes a great company a phenomenal investment. Your job, in the calm before the storm, is to identify these great companies. You're looking for blue-chip businesses, established leaders with powerful competitive advantages. Think about companies whose products or services you'd keep using even in a recession. While some analysts see potential in sectors like technology and financials, you have to be selective. The key is to find companies that are translating hype, like the current AI boom, into actual tangible profits. A company with a cool AI side project is a speculation. A company using AI to make its main business more profitable is an investment. So, how do you find them? Look for a few key things. First, a strong balance sheet with debt that's under control. A company drowning in debt is fragile in a recession. Second, look for consistent and growing free cash flow. Cash flow is the lifeblood of a business. Third, find a management team with a proven track record of navigating tough times. And finally, look at its valuation. Even great companies can be too expensive. A correction can bring individual company valuations back down to earth, creating your buying opportunity. Your game plan should be as systematic as your research. Decide on the total capital you're willing to deploy from your war chest over, say, a 12 to 24-month period. Divide that into equal monthly or quarterly chunks. Then, you just execute. You invest that fixed amount on the same day every month, whether the market is up 5% or down 10%. You have to stick with it, especially when prices are falling. That's exactly when the DCA strategy works its magic. This methodical approach ensures you're buying at every stage of the downturn and into the early recovery, mathematically guaranteeing you capture value. If you're finding this blueprint valuable, do me a small favor and hit that like button. It tells the YouTube algorithm that this is the kind of practical, no-hype financial strategy people are looking for, and it helps the channel reach more people who are ready to take control of their financial future. Thank you for that. Now let's get into the third and final step of the plan. Thriving in chaos. Real estate and entrepreneurship. The greatest wealth is often created where nobody else is looking, in the corners of the market that Wall Street tends to ignore. While step 2 was about stocks, step 3 is about capitalizing on opportunities in the real world. Distressed real estate and entrepreneurial ventures born from chaos. First, let's talk real estate. A major market correction, especially one that tightens up credit, almost always sends ripples through the property market. This creates 2 clear paths for savvy investors with cash. The most direct is buying distressed properties. When homeowners or landlords get into financial trouble, they might have to sell their properties at a huge discount. Foreclosures and short sales become more common. For an investor with dry powder, this is a chance to buy income-producing assets or a future home for pennies on the dollar. These properties can be held as long-term rentals, generating cash flow through the downturn, or fixed up and sold for a nice profit when the market bounces back. You see similar opportunities in commercial real estate. Recessions force businesses to downsize or close, leaving behind empty offices, storefronts, and warehouses. These can often be bought at deep discounts from motivated sellers. This opens up possibilities for repositioning, turning an old office building into apartments or converting a failed retail space into a last-mile delivery hub. But you don't need to buy a whole building. For those who want exposure without the headaches of being a landlord, Real estate investment trusts, or REITs, are an excellent option. REITs are companies that own and operate income-producing real estate, and they trade on the stock market. A correction will push down the prices of even the highest quality REITs. Some analysts see long-term potential in areas like U.S. core real estate and global transport infrastructure. Buying into a REIT during a downturn lets you get diversified exposure to real estate with professional management and the ability to sell easily, all while collecting dividends. Now, beyond just investing, a market downturn is ironically one of the best times to become an entrepreneur. Chaos creates opportunity by shaking up the old guard. The biggest advantage is a huge drop in operating costs. As other businesses cut back, commercial rent gets cheaper. Service providers, like contractors and consultants, are more willing to negotiate their rates. Suddenly, the cost to launch a new business plummets. More importantly, recessions create service gaps. As large, bloated corporations pull back and lay people off to protect their profit margins, they inevitably leave customers underserved. An agile entrepreneur can swoop in and fill that gap. Think about it. During a downturn, people repair things instead of replacing them. This creates demand for auto repair, appliance repair, and handyman services. Businesses, desperate to cut costs, might fire expensive in-house teams and hire affordable freelance social media managers or digital ad specialists. These are the kinds of lean, service-based businesses that can be launched with little more than expertise and hustle, and they can boom during a slowdown. There's also the chance to acquire entire businesses. Many solid small businesses fail, not because their product is bad, but because the owner was over-leveraged or couldn't manage cash flow. An entrepreneur with capital and know-how can buy these distressed businesses for a fraction of their true value, fix them up, and position them for explosive growth when the economy turns. Beyond stocks and real estate, you should also look at other alternative investments. Assets like private equity, which involves investing in private companies, are often projected to deliver strong returns over the long term. Infrastructure projects can also offer stable returns and are less tied to the swings of the stock market. These alternatives provide another layer of diversification, making your entire portfolio more resilient. Step 3 is about remembering that value isn't just found on a stock ticker, it's all around you, waiting for a prepared mind to see it. So, what's the bottom line? The prospect of a major market downturn, whether it's in 2026 or another year, isn't a prediction of doom. It's a call to action. It is the starting gun for a generational wealth transfer, and you now have the blueprint to be on the right side of it. We've walked through the 3 essential steps. Step 1. Build your fortress. You're going to set up a 6 to 12-month emergency fund for security, then build a separate war chest of dry powder for opportunity. You're going to strengthen your finances by cutting debt, creating a lean and flexible profile. Step 2. Go on the offensive in the stock market. You'll ignore the noise and the panic and instead execute a disciplined dollar-cost averaging strategy. You'll use this quiet period to create a hit list of world-class blue-chip companies, and you'll buy them systematically as prices fall, turning volatility into your greatest ally. And Step 3. Think beyond Wall Street. You'll look for opportunities in distressed real estate, either directly or through liquid REITs. You'll adopt an entrepreneurial mindset, spotting the service gaps and low-cost startup opportunities that a recession creates. This integrated approach, a strong cash position, systematic equity investing, and opportunistic real-world assets, is how you navigate the chaos. Your portfolio should reflect this balance: cash for safety and opportunity, quality stocks for long-term growth, and a slice for alternatives like real estate for diversification. The most important thing to remember is this all requires a long-term perspective. The goal isn't to be a hero who perfectly times the bottom. The goal is to be the disciplined investor who methodically builds wealth through a period of temporary disruption. Don't let fear write your playbook. Let preparation, discipline, and a clear-eyed view of the opportunity guide your actions. The next great wealth transfer is coming. You are now ready. I invite you to continue delving deeper into the world of finance and business. Here is another video and a playlist, one step at a time.